Okay, Assalamualaikum and salam sejahtera. Okay, I'm going to proceed with step 2 of revenue recognition model. Okay, that is identify the separate performance obligations. Okay, what is performance obligation? Okay, performance obligation refers to a promise to transfer to the customer a good or service or a bundle of goods or services that is distinct. Okay, what is the meaning of distinct good or service? Okay, distinct good or service means the good or service is separately identifiable. Okay, separately identifiable from another good or service. Alright. So in order to identify a performance obligation, we need to ask ourselves whether the promised goods or services, okay, transferred by the seller to the customer, okay, are distinct from other goods or services in the contract. Okay, basically, when the goods and services are distinct, okay, they are considered as separate performance obligation. Okay, there are two criteria for determining whether a promised good or service is distinct. Okay, the first criteria is capable of being distinct. That is, customer can benefit from the good or service on its own or together with other readily available resources. For example, a customer can purchase the handphone only or the network service only from the seller, or the customer can purchase the handphone together with the network service. All right. Therefore, the handphone and the network service are considered as two performance obligation. Okay, so in this situation, okay, the customer can benefit, okay, from using the handphone of from purchasing the handphone only, or the customer can benefit, okay, from purchasing the handphone together with the network services. Alright, so in this situation, the handphone, okay, and the network service are considered as distinct, okay, or separately identifiable from each other. So there are two performance obligations there, that is the handphone and network service. Okay, the second criteria is distinct in the contract, in the context of the contract. Okay, that is the good or service separately identifiable from other promises in the contract. Okay, they are not highly interdependent or interrelated. Okay, for example, a car manufacturer can sell the components of the car individually, such as the frame, the engine, the windows, the tires, and so on. Okay, so each component is treated as separate performance obligation. Okay, but if the contract states that the manufacturer is to sell a wholly manufactured car, okay, then all the components will become highly interrelated or interdependent. Okay, the manufacturer needs to combine all the components of the car to produce a wholly manufactured car. Okay, thus selling the car is considered as one performance obligation. Alright, okay. Okay, how to assess whether goods or services are distinct or separately identifiable? Okay, we need to identify in the contract, okay, whether the good or service is transferred individually or not. Okay, if the good or service is transferred individually, okay, then they can be considered as distinct, okay, from another good or service. Okay, so they can be treated as a separate performance obligation. Okay, the second situation, okay, we need to identify whether the goods or service, okay, are transferred as combined items or outputs. Okay, if they are transferred, okay, the goods or services are transferred as combined items or output, okay, we have to identify whether these combined items are highly interrelated or highly interdependent or not. Okay, if they are highly interrelated or interdependent, okay, they must be treated as one performance obligation. Alright? Okay, let's have a look at this example. Okay, this example is on a single performance obligation. Okay, let's check out this example together. Okay, Softec Berhad licenses customer relationship software to Lopez Company. In addition to providing the software itself, Softec Berhad promises to provide consulting services by extensively customizing the software to Lopez Information Technology environment for a total consideration of 600,000. Required, identify the performance obligation in the above revenue arrangement. In this case, Softec Berhad is providing a significant service by integrating the goods and services, that is the license and the consulting service, into one combined item for which Lopez has contracted. In addition, the software is significantly customized by Softec Berhad in accordance with specifications negotiated by Lopez. Okay, the license and the consulting services are distinct, but they are highly interdependent or interrelated. Therefore, okay, the license and consulting services should be accounted as one performance obligation. All right. Okay, let's have a look at another example. This is for separate performance obligation. Okay, let's check out the example together. Okay, Chen Computer Berhad, okay, manufactures and sells computers that include a warranty to make good on any defect in its in its computers for 120 days. In addition, it sells separately an extended warranty which provides protection from defects for 3 years beyond the 122 days. Okay, required. Identify the performance obligations in the above revenue arrangement. Okay, in this case, okay, two performance obligations exist. All right. What are the two performance obligations? Okay, first, sale of the computer and the assurance warranty, and the extended warranty, that is the service warranty. Okay, we have two performance obligations here. Okay, the first one is the sale of the computer and the included warranty. Okay, these two items are highly interrelated and interdependent, so that's why they are treated as one performance obligation. Okay, the second one is the extended warranty that was sold separately. Okay, so they are two performance obligation altogether. All right. Okay, the sale of the computer and related assurance warranty are one performance obligation as they are interdependent and interrelated, okay, with each other, as I mentioned just now. Okay, however, the extended warranty is separately sold, okay, and is not interdependent. All right. Okay, now let's move on to step 3, that is determine the transaction price. Okay, what is the meaning of transaction price? Okay, transaction price refers to the amount of consideration that company expects to receive from a customer. Okay, in a contract, transaction price is often easily determined if the customer agrees to pay a fixed amount. Okay, so it is easy to determine the transaction price if it involves a fixed amount. Okay, however, some contracts, okay, might involve, okay, the transaction price that includes variable consideration, time value of money, non-cash consideration, and consideration paid or payable to the customer. Okay, however, for 4 to 70, we only focus on the transaction price that involves a fixed amount only. Okay, all right. So we go to step 4, that is to allocate the transaction price to the performance obligations. Okay, so in order to allocate the transaction price to the performance obligation, okay, it must be based on the relative fair values of the goods or services. Okay, so to allocate the transaction price to the performance obligation, we must apportion the transaction price to each good or service, okay, by using the fair value, okay, of the goods or services, okay, that are sold on a standalone basis. Okay, so standalone basis here means on individual basis. Okay, we must reapportion the transaction price, okay, to each service, to each goods or service, okay, by using the individual selling price, okay, of the good or service. Okay, if the selling price or the fair value of the goods or service is not available, the company should use the best estimate of what the good or service might sell for as a standalone unit. All right. Okay, let's have a look at this example. Okay, entity A has a contract with customer B to sell computer equipment, provide training and operate an IT help desk. Okay, each of these has been assessed to be separate performance obligations. Okay, the total transaction price has been determined to be 1.2 million. All right. Entity A determines that the standalone selling price for each distinct good or service is, okay, for the computer equipment, the standalone price is 750,000. Okay, training 150,000 and help desk 600,000. Okay, the total of standalone prices is 1.5 million. Okay, as you can see here, okay, if we purchase the good or service individually, okay, the price of the good or service is much higher, okay, compared to the price when the goods and services, okay, are purchased in a bundle. Okay, when we purchase the goods, all the goods and service, okay, in a bundle, we can purchase at 1.2 million. But if the goods and services are purchased individually, okay, the total price will be 1.5 million. Okay, so the price is much higher compared to the price when we purchase them in a bundle. Okay, required. Allocate the transaction price for each performance obligation. Okay, let's have a look at the solution. Okay, how do we allocate the transaction price, which is 1.2 million, okay, to each service performance, okay, to each goods and services. All right. Okay, so we're gonna apportion 1.2 million to each item, okay, based on the standalone price, okay, of each item. Okay, for computer equipment, okay, the transaction price is 1.2 million, as we know. Okay, so we must time with the standalone price of the computer equipment divided by total standalone price, 1.5 million. So we get 600,000 allocated to computer equipment. Okay, for training, okay, we take the transaction price times the individual or standalone price of the training cost, okay, divided by total standalone price. So we get 120,000 allocated to training. And for help desk, okay, the same thing, we take 1.2 million, okay, times the standalone price of the help desk divided by total standalone price. So we get 480,000 allocated to help desk. Okay, so altogether we get total transaction price 1.2 million. Okay, so this is how we allocate the transaction price 1.2 million to each item. Okay, all right. Now let's go to the last step, okay, that is to recognize the revenue when the entity satisfied a performance obligation. Okay, revenue is recognized, okay, as performance obligations are satisfied by transferring promised goods or services. Okay, so company satisfies its performance obligation when the customer obtains control of the good or service. Right? And company satisfies performance obligation either at a point in time or over a period of time. Okay, so company satisfies performance obligation at a point of time. This is more related to uh, goods or services. Okay, related to transfer of goods. Transfer of goods. For over a period of time, this one is more related to service, all right? Because service is performed usually over a certain period of time. Okay, so the company, okay, may satisfy its performance obligation, okay, when the service has been performed, okay, over a certain period of time. Okay, for the point in time, okay, this is more related to the transfer of goods, all right? Okay, now we go to the indicators of control transfer. Okay, so as we can see just now, as I mentioned just now, okay, the seller, okay, satisfies its performance obligation when the customer obtains control, okay, over the goods or services. Okay, indicators that a customer has obtained control, okay, include, okay, there are 5 indicators actually. Okay, the first one is, okay, entity has, okay, the company has a right to payment for the asset. Okay, the second one, the company has transferred legal title of the asset to the customer. Third, okay, the company has a physical possession of the asset. Fourth, the customer has significant risks and rewards, okay, of ownership. And the last one, the customer has accepted the assets. Okay, these are the 5 indicators that a customer has obtained control over the goods or the assets.